What is depreciation? Let's have a look at one of the most interesting items of the accounting statements that is directly linked to all the statements we have already looked at in other sections, such as balance sheet, income statement, and cash statement. Pretty much every asset that we have on the left side of the balance sheet has its useful life expectancy. The first example that comes to mind is a computer or a phone that you read this article from or listen via the podcast. It is not going to last you forever. Most of the modern electronics are replaced within 2 to 3 years. Let's say you listen to this from a new iPhone 13 that you have bought for $1,000 and you expect it to last you 24 months. At the time of the purchase, given you bought it for cash, you decrease your cash on your personal balance sheet by $1,000 and then add an item called iPhone or other communication device worth $1,000. If you were a firm, you would prorate this money over 24 months at $41.67 and add this as an expense to your income statement, simultaneously decreasing the value of your asset. So by the end of the year 1, your phone is worth $500 and you would incur an expense of $500 for that same year. You are planning on using this over time, hence it would be misleading to bulk all expenses on one day today. What is interesting though, this decrease in assets would have a negative effect on operating cash flow today with decrease of $1,000. However, it would positively impact cash from investing 1 year from now due to depreciation. Similar approach is taken by the firms to account for the assets that do not have infinite life, and their accounting would be based on the expected life of these assets. Such expenses include machinery, plants, and are typically included under property, plant, and equipment line of the balance sheet. Depreciation approaches. The example with an iPhone above refers to the most used straight line depreciation, where the assets are depreciated by equal installments over each of the time periods. In our example, it was years. There are also some additional types that different firms may consider, such as declining balance. This one is linked to the percentage depreciation of the total balance. Instead of dividing the value by years, it is multiplied by the percentage set and then applied annually to the carrying amount. This would result in a larger depreciation in the early years. Another example is double declining balance. It is much like the declining balance, however, it uses the adjustment value that can either double the standard rate or possibly applied with a different accelerated constant that results in even larger depreciation or potentially smaller in the early years. Then there is sum of years depreciation. This approach weights up the years and reverses them. So if the asset's expected life expectancy is 3 years, the depreciation would be 3/6 in the first year, 2/6 in the second year, and 1/6 in the final year. And the final one is units of production. This one is an exception compared to other items. Instead of being linked to the years of useful life, this approach calculates it based on the total number of output units that can be produced by the asset. Accumulated depreciation and salvage value. Depreciation is accumulated over time on the balance sheet, and it is a counter account to the asset it relates to. So for our iPhone example, after 1 year, the accumulated depreciation would amount to $500, decreasing the value of our assets to a net of $500. The salvage value is the minimum amount to which we aim to depreciate the asset. Some assets might have an expected value that is higher than the zero. For the examples listed above, the calculation with the salvage value would be the same, but all formulas would need to be applied to depreciable amount. So for example, we could say that we can resell the iPhone after 2 years for $200, we can set the salvage value to those 200, and then over 24 months our depreciation would be 800, so just 400 per year. There is a specific formula for this, so total value minus salvage value equals depreciable amount. In our case, $800 with iPhone that can be resold for 200 in 2 years.